Good morning. My name's Patrick Malcolm from GFM Wealth. Welcome to all our clients and guests to our webinar today. I'm meeting with Nick Edgerton from Stewart Investors, who I'll introduce in a moment. I'm a little bit sick of saying this, but we hope everyone is doing well at home, both people in Melbourne and Sydney. We've got a little bit of joy in Melbourne today with some restrictions being lifted, so hopefully everyone can enjoy their a little bit more freedom sensibly. If you're in Sydney, we feel for you at the moment. We know what you're going through. Not sure whether people have tracked this, but the last webinar I did, we were also just coming out of the lockdown as well. So I'm not sure whether I'm good luck or bad luck. Got some Irish heritage, so I'm going to say it's good luck. So onto the webinar. The first thing I want to do is I just need to show everyone our disclaimer. Which is really important. So it's really important that everyone understands that the advice that we're giving today is general in nature. And if you want to speak to one of the advisors at our firm about your situation, it's really important that you do that. So please feel to give us a call if you want to discuss the investment in the context of your portfolio. So I'm going to introduce Nick Edgerton from Stewart Investors. So Stewart was founded in 1988. It's got offices in Edinburgh, London, Singapore and Sydney. Nick is a portfolio manager for the Worldwide Sustainability Fund, which we'll be talking about today. The fund is certified by the Responsible Investment Association of Australia, or the RIAA. Had some difficulties when Googling RIAA because RIAA is also gives out gold records and platinum records in the US, which Stewart certainly doesn't have. The fund's averaged a return of 14.2% since inception, beating the index, which we think is super impressive given the style of the manager over that time. The fund turned 7 on the 1st of August, which isn't too far away, and it's gold rated by Morningstar as well. So Nick, welcome to our presentation this morning.
Thank you, Patrick.
So, look, the first thing I wanted to ask is, can you talk a little bit about the members of the team that you've got, Nick? So we obviously had a webinar with you last year and you told us a little bit about your background. Can you talk a little bit about the members of your team? We're very conscious of the fact that a portfolio manager is the sum of its parts. So can you talk a little bit about the people you work with and the importance of having a good team when you're running a portfolio?
Yeah, thanks for the introduction. Yeah, we started in 1988 in Edinburgh, which for those who don't know is actually a real hotbed of funds management, quite a long history there. And we started in running sustainable investment funds in 2005 when my colleague David was backed by some clients in Sweden to explore options more fully around sustainable development and equity investment. And then over time we moved, that was with an Asia Pacific sustainability fund. We then moved in 2009 into emerging market sustainability. And then this worldwide strategy actually started in the UK in 2012 and more recently in Australia. As a firm, we were getting quite large in 2015. So we decided to split in half. We think there's actually diseconomies of scale with funds management. And then today, we're managing around about 33 billion Australian dollars across Asia Pacific, emerging markets and worldwide investment funds, particularly sustainability-minded funds. And so as a team, we're generalists as opposed to the industry specialist structure that many managers have. And that's a really interesting forum to work in, I believe, because what it means is that we'll go away and try and dig up ideas. We're tasked with being ferrets, digging away, trying to find great ideas that fit with our philosophy and process. And we've all often been involved in analysing the companies that we come to the table with. So rather than being in an environment where, say, I might be the tech specialist and there might be a chemical specialist across the table, I don't have to worry about those biases that arise from me thinking I'm right and them not being able to fully challenge. At the same time, I can lean on other sort of thoughtful, interesting people for their views and views of people who think differently in diverse ways. And so I'll just point out some of the people. We operate across 4 offices. we've operated across geographies since 2000, so we're quite used to it. But the momentum of the new people we've brought in has been fantastic. Our last 4 hires are all brilliant young women. Just to give you a bit of a flavour for it, I'll pick out a couple recently, but a lot of the people we hire are educated in multidisciplinary areas. They come with diverse viewpoints, having been educated or lived in different continents and have different backgrounds. So we've recently brought on people like Anya in Edinburgh, who studied philosophy at Wellesley and then law at London, and then went and worked on writing a novel. People like Hannah, who's from Switzerland, who studied sort of social enterprise at McGill and then sustainability in Australia. And people like Sajaya, who's an Indian national from Singapore, who studied development studies in Cambridge and then international relations at Brown. And so you've got a really diverse set of people there who are not trained only in finance. They are trained in a diverse range of disciplines, have different work experiences, and come to the table with a level of critique with different views. So no matter how smart I think I might be, or someone else who's done a piece of work, the reality is there's 13 people around the table who are going to have some ideas that you haven't thought of.
They'll kick you all out of the Fund Managers Association with your qualifications, Nick. There's no CFAs or Masters of Applied Finance or those sorts of things.
No, and there are a couple across the team. We don't list them there. There are a couple across the team. There are certain regulatory financial qualifications we need. So there's things like not the full CFA, the CFA level 4, for example, you have to have done to operate in the UK, which most of us have. But it's that balance, because ultimately our job is not just crunching numbers on a spreadsheet. Our job is broader than that. It's understanding the geopolitics that companies operate in, the direction of travel and the challenges that they have economically, socially, environmentally. And then on top of that, where are they high quality, successful businesses? And pure finance doesn't give you all of those things all the time. I'll just lastly point out that we've got no chief investment officer, no house views, no investment committees, and recognizing that while individuals can make mistakes, those committees can make poor decisions, and all of us are there to try and help identify, do the pre-mortems of what the mistakes might be, and working with each other in digging up these ideas.
Understood. Now, we know the name of the firm, Stewart, is a play on the concept of stewardship. Can you talk about stewardship and how that is important when it comes to investing, Nick?
Yeah, sure. We try to keep investing pretty simple. We think that we pretty much need to earn the right of our clients, earn their trust in terms of getting them to entrust us with their hard-earned capital. And at the same time, we need to find people we can trust that we're handing their money over to, who are running companies. And so in doing that, what we're looking for is really integrity behind the people that we're investing in. And that's because ultimately, if we're involved in short-term trading, if you're trading quarter to quarter or even for a year, it might simply be about picking which franchise might win this year in terms of who might sell more than we expect. If you're looking at allocating capital for the long term to people running a business, really you've got to understand their motivations, their incentives. You've got to see that they have integrity, ideally some humility as well, because it's an incredible facet required for learning and improvement. And on top of that, when you're investing globally, the reality is that companies and management teams have the ability to siphon money away from you as a shareholder. And it's not just potentially overpaying themselves, but there are dubious related party transactions, there's aggressive accounting, there's even all the way through to more colourful stock market manipulation and fraud. And there are many, many cases of that. And it's not just the more colourful economies it happens in. You know, if you've looked around, places like Wirecard in Germany more recently, Carillion in the UK. So it does happen. And where we find these people, these stewards, that we can entrust money with is a whole range. And what you've got there on the slide is a split of our portfolio in the darker green, which shows the companies and whether there is someone who owns equity in the company who has a significant bearing on running that business. And what we have as a split in our portfolio is that about a quarter happen to be family-backed companies, around 20% entrepreneurs, and then foundations, and then half of it is free float. So if you think about the Australian economy, what we're primarily used to is free float companies, which means all of the shares are available for people to buy. If you step outside of Australia, you actually get markets such as India, but certainly places like Germany and elsewhere, where there are a large number of listed family-backed companies. So you've got multi-generational families who have brought companies along, and they run their companies differently. It's not about meeting the next quarter. It's about the family name on the door or on the product, and it's about handing over the business to the next generation. So where you can find that integrity and that competence and that skill, what we're able to do is go along for the ride of this incredible business that has longevity and that will have a long future, and earn some of the profits along with other people. The motivations there are completely different to a free float business, where on average you have a manager who's run it for 3 or 4 years, and then they'll be gone, and they're looking at maximizing whatever their targets may be for their remuneration. So the businesses tend to be run differently, and you can get good and bad in both. It's by no means a panacea to a good or a bad investment. But where you find that longer term minded steward behind a business, it can be a really compelling investment opportunity.
Okay, so we're going to pick apart each part of the fund's name, Nick. So we've gone through Stewart. I want to talk about how you define sustainability. What does Stewart look for, and what do you think makes your fund different from other sustainable investment alternatives out there?
Yeah, sure. So let's touch on the sustainable development idea first. And in a way, it's quite a simple idea. My 12-year-old son can understand it, in that what we're doing really as a global economy and as our countries is provide more for its people, but with a lighter footprint on the environment. But on top of that, there's lots of layers really when you start unpicking that, because the way economies progress through time is obviously as they produce more for their people, and whether it's just those basic necessities around housing, education, health, or through to more discretionary consumption over time, they consume far more resources and create more waste. And so what that means is that countries like Nigeria and India and many others can't actually develop the way that we have in Australia. And we think this provides a massive opportunity, because when you both in Australia, but when you step off our little island that's enclosed at the moment, the world at the moment is going through this rapid decarbonisation, rapid electrification of the economy. There are hundreds of millions of people beginning to consume very basic goods that we might not consider. Soap, shampoo, detergents, real basics, where when you reach that $1 to $5 million of per capita GDP, you start consuming these goods. And these changes in the economy will be touching everything. So electrification is not just about electric vehicles. It's about every single part of the economy, how we do things. Technology as well brings incredible benefits, but also threats. So obviously things like cybersecurity, and we've seen that quite a bit this year, is a huge industry that we need to get on top of for social need and social good. And so, it's quite a different market than when you think about investing in Australia and you think about the ASX, which is dominated by some fairly comfortable banks, some almost uncompetitive retailers. You've got the resources, the oil and gas casinos and the like, and some very, very high quality healthcare companies that we can talk about a bit later. But sustainability for us really touches every part of the economy. And
which
so
which I think is interesting, Nick, because I think the focus on sustainable investing is really this very sort of intense lens on renewable energy. And we can see from all the sectors here where you've classified them that there is a breadth there, isn't there? It's not just exposures to renewable energy, it's all these other sectors and segments as well.
Exactly. So what we're looking for is companies that understand that these are some of the challenges we have in our economy and in the global economy. And at the same time, they're going to generate good profit. So they've got a good tailwind behind them by what their purpose is, what they're actually doing. And so it's not just solar and wind. It's moving into looking at accessible and affordable healthcare, looking at mortgages for the first time for millions of people in places like India, looking at concepts like micro-insurance, where people for the first time have assets and actually need to insure them for either their small business or their property. And then more broadly, issues of equality and equity and diversity, because again, it tells us so much about a company by the landscape they look at and how they operate in. So just to give you one example, we invest in an India company called TCS. You think about, with the 50,000 companies out there that we can potentially invest in, it's fascinating to pick up on the little markers that tell you about the attitude of a company and what they're trying to do. TCS, one story I love about them is that they operate throughout the world, but they operate in Saudi Arabia as well. And they've set up a business processing center in Saudi Arabia. So they're a tech business, which is a women-only center. So they've got 1,000 employees, 85% of them are local, and they're all women, really skilled, clever female tech engineers operating in Saudi Arabia. I mean, that's the type of thing which not only is going to create huge change, but hopefully has a supportive tailwind in terms of their role in the global economy and what they're doing.
Interesting, really interesting. Now, so we've picked out the Stewart, we've picked out the sustainability, we're going to jump to worldwide, Nick. So your investment universe is global equities. Can you talk about some of the challenges of navigating different economies, cultures, legislations when you're picking stocks for the portfolio?
Really quite timely as well, in that I don't anticipate many will have seen it, but there's been a massive shift in the last 3 or 4 days out of China, which has been a really good example. So over the last few days, China has come out saying that any private education companies are going to be non-profit in future. And this is what a country can do, and countries with authoritarian control can do particularly, but there are a great deal of listed private education companies. And some of them are listed in the US as well. And so companies like TAL Education, for example, in the space of 2 or 3 days has fallen 92%. There's another company in China, which is an education company, has fallen about 96%. And this is where you do have to be very careful operating in different countries and understanding how you as an outside investor are aligned with the license to operate of that company. Now, there's been a huge knock-on effect here. It's not just the education companies. The last few days has seen quite a strong sell-off of Chinese tech businesses as well, including any Chinese tech businesses listed elsewhere, like in the US. It's just a really good reminder that you need to understand the stewards you're giving the money to and what environment they're operating in and how their license to operate can be lost. We ourselves, we're not immune to this, obviously. We run into trouble as well. One of our companies, Visasoy, the soy milk company listed in Hong Kong, has had difficulties in the last 2 weeks where an employee was caught up in some civil disobedience where they harmed a police officer in Hong Kong. There was an internal memo that was sent between employees basically sympathizing with that person. And that got out into China and then onto social networks to the point where you had a bit of a social network government-inspired boycott in China, which is a very large company, a large market for them. And that's really negatively hit them in the last week or two. They've come off about 20%. And so you have to be careful in understanding the environment you operate in. We've always struggled with investing in Russia. We don't have any investments in there. I know from experience before COVID, traveling around, getting the lay of the land is very instructive. And countries where you think are quite colourful and exciting are actually some of the easiest ones to pick out some of the warning signs. So, I mean, I remember in around 2013, 2014, being in Nigeria and meeting with a load of companies. There's some good soap companies there, for example, some good bread companies. Again, really basic needs for people, 300 million people coming out of poverty. But it's quite clear when you visit Lagos Lagoon by the US Embassy, when you see no boats there except for two mega cruisers sitting there, and you find out who owns it, that you don't want to go near that company of the guy who owns the boat. Yep. Because, you know, in those markets, you don't get that wealth that way. You need to be cautious if you're handing over the money to people who are operating that way. And so you need to be careful of the customs, the culture, but the regulations too. We've seen, 20, 30 years of a race to the bottom globally on tax rates. Janet Yellen and others have signaled that may have ended and we may be at an inflection point. There's issues recently of things such as sugar taxes. There's now over 30 countries with sugar taxes. The UK is revisiting that again. You need to understand how your companies are operating within the different trends in different countries. And before COVID, we used to try and get a handle of that by traveling, talking to local journalists, talking to competitors, talking to people on the ground. Now, obviously, like everything else, we do a lot more of that virtually.
Understood. Now, I'm going to get in a lot of trouble if I don't ask this, Nick. And I think this highlights 2 points. So first and foremost, that Australia is only 2% of the world share market, but there's also an Australian stock in the portfolio. Now, I'm going to confirm that that's CSL.
Yeah, there's two. There's Cochlear as well.
Cochlear, which we'll talk about. We're not going to talk about CSL. So just so you know, Nick, in the office, it's Paul's job to talk about CSL, not my job. So I want to talk about, and there's some Australian businesses that I know you've looked at in the past. Obviously, you've got CSL in the portfolio. At the end of May, it was the 10th largest stock in the portfolio. You spoke about Cochlear. I know you've looked at Atlassian and Xero as well. Atlassian is unique because it's an Australian business that's listed in the US, so we might leave that to the side. So could you spend just a little bit of time talking about what you like about Cochlear and Xero, if that's possible?
And Cochlear, sometimes when we look at the Australian stock market, well, we can be a little bit disenchanted, I think. But there's some things we can be really proud of.
Just banks, resources, supermarkets, Telstra, and a few retail shopping centres.
There are very few who have taken on the world and won. You know, there's not many. We've named a few of them already, but there's not many of them. Cochlear is one we should be proud of. So cochlear implants, a hearing implant. The cochlear is a key part inside your ear, which picks up the vibrations and converts it into your brain to be able to hear. And the implants are the sophisticated implants inside. So it's different to a hearing aid. You'll sometimes see people with a patch on the back of their head. That's a cochlear implant. It's a wire going right inside your ear as opposed to a hearing aid, which is basically a trumpet in a way. So in the late 1970s, an Australian professor, Graham Clark, worked out the ability to put an implant inside the ear to allow those who are profoundly deaf to be able to hear. It's from Australia. It's gone global. There are people all around the world now children and adults who had complete hearing loss who can now hear again thanks to this incredible surgery. And the benefits are obvious other than what I've just said. People have tried to measure it as well. So as an example, adults with hearing loss are apparently around 3 times more likely to have low education levels, almost 2 times more likely to be unemployed as well. And also those with profound hearing loss actually on average earn 77% less money. And now there's also studies that suggest there's contributions or links between profound hearing loss and dementia. And so there's huge social benefit out of people, helping out people with profound hearing loss. And so why Cochlear then? Why this one? Because there are 3 or 4 companies now that do it. First of all, they have the leading market share. They were the first to the market. They've been the most innovative. And they've done that through consistent, very high levels of research and development expenditure. So they're up above the teens, up into 20% of sales, which is a very high number. You know, anything in the high single digits tends to be quite a clever industry. What they're able to do then is generate very high returns, profitable returns for shareholders. And so they're up around the 40% return on equity level business, which is a very high level. You can create then with growth a circular effect of increasing returns to shareholders as the rollout of the business is in that sort of mid-teen, so their growth at the sales level. It's a business which does have its weaknesses like any business as well. So they're relying on relationship connections with surgeons. They're relying on surgeons wanting to use their device for implants. And so it's a really good test of the quality of the innovation, the quality of the product, because if you think about it, if you're a surgeon, the last thing you want to do is implant something into someone's head, which is going to lead to either defects or faults or worse infections. And same as if you're willing as an individual to let someone put something inside your skull, you want to make sure it's the best. And so they've consistently held the leading market share because they've consistently had that innovation and quality angle, and done so as a great Australian business moving into Asia Pacific, Europe, Middle East, and America. Just lastly, why now? We invested in it last year. Obviously, with COVID, one of the big things that have dropped off is surgeries. So they had a terrible year the last couple of years. The valuation drop gave us an opportunity to buy into it, and hopefully it's one that we'll be able to own for a long time.
And Xero, very quickly, Nick?
Yeah, so Xero is as Australian as Russell Crowe or Crowded House. They're Australian now, a gift from New Zealand. It's basically... it's basically software. It's an entirely cloud-based accounting software for small and medium businesses. So we like it on the sustainability side as just being one of those critical utilities, critical piece of infrastructure for small businesses to grow. Before this, you were dealing with the traditional enterprise products, or even just dealing with your accountants and paper-based solutions. They came on board and said, right, we want to develop a product that's more mass market in nature, low customization, easier to implement, easier to use and learn, and small businesses can use it. It's cloud-based, which has given them the advantage above competitors like Sage in the UK, Intuit in the US. Growing very quickly. It has a very scalable SaaS model, the software as a service model, and really good low centralized costs. So obviously developing new little programs and components that then can improve the user experience, and obviously then improve the revenue out of the users and the recurring cash flows. So really good track record of doing that. Relatively young company. The entrepreneurial founder has stepped away from the more running the business, but still owns a fair amount of the equity. So we've got that link in with a longer term steward who's got care for the business. But again, one that is taking on particularly the developed part of the world, the Europe and UK in particular, very strongly. Interesting.
Now, one thing that's come out in the press that's been discussed for a little while now, and I think it's good off the back of a discussion around sustainable and ethical investing, are the concepts of greenwashing and brownwashing. So maybe you could focus on greenwashing. Nick, maybe just explain very briefly what it is and really what you do to try and avoid investing in companies that are just greenwashing.
Yeah, so greenwashing is basically painting a much more positive picture about your environmental impact than you're actually doing. And it's obviously critical because there's that, you might have heard of it, the Edelman Trust sort of studies, a barometer. There's an Edelman Trust barometer. And I think it was a year or two ago, it had the finance industry was the least trusted business sector, which is I got a smile on my face, but it's hugely disappointing.
Thanks for raising that, Nick.
So, we need to work on this, and we need to improve it. It's incumbent on us to do that, and transparency is one of the key ways to do that. And we, as you know, strongly believe on that. And if anyone goes to our website, sfg.stewartinvestors.com, you'll see a huge amount of transparency about where we are putting our money, what our concerns are with the companies we're invested in as well, and how we're thinking. So what are some of the issues to look out for, and what do we look out for with companies? Well, the obvious is a lack of balance, particularly when they're picking out case studies of small parts of the company, of what they're actually doing, and the positive impacts and the risks they face. I guess the second would be we look for the level of disclosure around the whole portfolio of the company, of all their products and services, what they do, rather than just the high level metrics or picture. We need to, there's a delicate balance between simplicity and explaining, but enough detail to rigorously road test and find evidence behind something. And it's not just measurability. It's evidence that sometimes is not measured, if that makes sense. I can explain that a bit more, but and then also it's a combination of both qualitative and quantitative judgments, because the numbers can lies, and damn statistics. But at the same time, you need something tangible often behind your thoughts and assertions. So we try and avoid it by finding in our companies those direct, clear links between things like their targets and what they're doing for the environment, and ways in which they can demonstrate it. We try and look for what's actually meaningful and relevant for the company. So it's not pure philanthropy. There's no point in a company doing horrible things with their core business, but saying it's okay because our charitable arm
absolutely
loads of money.
Yeah,
and so it's about demonstrable, not just measurable, detail and evidence, not just simplistic, and making sure it's the core purpose of what the company is actually doing.
Yeah, and now brownwashing's come out a bit. It's been discussed for a long time, and this is just businesses just jettisoning things to make them. So brownwashing is in effect a form of greenwashing, isn't it? So how do you engage with companies around brownwashing, and maybe just explain a little bit better than what I did around the concept of brownwashing?
Yeah, it's quite new. So I've only seen it a couple of times, but it is. I think it's about getting rid of the uglier parts of your business.
Yeah, just getting rid of them and giving them to a private equity firm, so it's out of the public eye, so that it's not on your balance sheet, and then it becomes someone else's problems. And I think there's some examples of some corporates in Australia that have done this in recent times, but we won't talk about that.
Yeah. So it's an interesting one, because there are so many issues to consider, and it's a big one around climate change as well, with what a term you may or may not have heard, a just transition, which is recognizing that actually in transitioning certain industries, you actually need to be very cautious and aware of both the people and the environment, and how that transitions. And so we've found it's a tricky one over time, because there's parts of businesses that we sometimes own that we don't love. We want to encourage them to run them down, generally by not investing in them, rather than the flip side is to build them up and really make them look really good and invest in them a bit and then throw them out to try and get the best value. Whereas we really want companies to try and sensibly run them down by provisioning for any environmental costs that might be there, being cautious of the people costs around employment or local communities or services provided, and doing that. So it's a really tricky one. We've encountered it with a couple of companies. We invest in Tomra, which is a fantastic reverse vending machine company in Norway, which provides recycling infrastructure in countries that don't have curbside collection. They also have sorting technology in agriculture, and one part was even in this, a tiny bit of it was for sorting tobacco. So we had discussions with them over several years about how they could effectively run that business down by moving out of it without cutting it off completely or trying to dress it up to get the greatest yield out of it. Another one was around actually an Indian company we owned that did personal care goods and had a small business on the side around skin whitening creams, and trying to get them to change messaging of that, and then look at exiting that part of it. So it's a particularly hard one, Patrick.
Yeah, it is. It is. They're challenges, but I think they're good challenges to come across and deal with. So I do want to jump to the performance of the fund. Nick, one thing that we think was super impressive was how the fund held up in that really tough period last time, or last year. I'm trying to avoid using the word COVID because I'm sick of hearing it, but nonetheless. But we see historically that the fund has performed really well in down markets. Outperformed in 69% of down markets and 39% of up markets and 50% overall, again beating the benchmark since inception, so that being able to compound off that higher base where you don't draw down as much. So the index fell 20%. That's the unhedged benchmark. There was a currency kicker there, and the fund only fell 9%, which was super impressive. So can you talk about why the fund held up well, recovery out of it as well? And just one of the interesting metrics I picked up in the fund, Nick, just looking at the slides, was the net debt to EBITDA measure, which I thought was fascinating. So across the world, that's 1.1. So that's the company's debt position relative to its profitability in effect. Yours is negative 0.3. So if you could touch on that as well, I think that would be great.
Yeah, sure. So we would argue that historically we do well in falling or difficult markets because of that quality investment piece. So we've got stewards running companies who are thinking about the business for the full cycle. It's not just the quarter. And that changes the way you set up the capital structure. It changes the way you look to invest in your own business. It changes the way you look to acquire other businesses. And it changes the whole setting of how you run that company. We're also involved in businesses with quality franchises. So for us, that's businesses that are often in control of their destiny. That means that they're not reliant on changes in commodity prices, or they're not reliant on government policy, or they're not reliant on something that will happen to enable them to produce good results. They've generally got good recurring earnings and recurring revenues, and their business keeps on going regardless of what's happening with the fluctuations in the economy. And then lastly, they've got quality financials as well. That is, they're running their capital structure and their financials quite conservatively. They're not running them at 110%. So the first little wobble, they fall over. And that's simple signs like, are they paying appropriate tax? Are they accounting aggressively or conservatively? And as you touch on, are they reliant on banks for loans to keep the business going? And so what you've explained is correct. The average company in the index has effectively 1 year's of earnings sitting on their balance sheet as net debt. So they owe the bank a year of their profitability. And obviously when things go wrong, the banker comes knocking and the stock market doesn't like it. And not only that, the company doesn't like it because they normally need that money to do stuff. If your company is healthy enough that you don't need the bank to help you out, so our average company has around 0.3, I think it's 0.3 to 0.5. So it's around a third to a half of a year profit sitting as net cash on its balance sheet. Then when times are tough, firstly, the banker doesn't come knocking. They don't have to worry about wage bills. They can look at any distressed competition or assets they might want to pick up. They can continue to invest in R&D. They can continue to expand. So why we did well? Well, we had companies like AIM Holdings, for example, which is in Japan, which is a drug dispensary company. So it's not quite a pharmacist. It's purely dispensing drugs, and has been the leader in the rollout of generic medicines in Japan. The way they have expanded as a business is purely off cash-generated funding. So it's a hugely fragmented market. They're generating really good recurring cash flows on necessary goods. They use those cash flows then to buy up smaller fragmented businesses and grow that way. They're not having to go to the bank and say, what deal can you give me on interest rate repayments to buy more of the competition? So when you got the crash coming, they had a fantastic opportunity. In the same way, companies like Diasorin in Italy, a razor blade model, it's a diagnostics testing business. They get machines out into facilities and then they earn profitability, really good recurring earnings through healthcare tests. COVID came along. Obviously, it worked out very well for them. And they were able to both invent new tests. So they had the first certified COVID antibody test in Europe. And then increase that throughput because people trusted their machines, knew they were reliable. They had this recurring cash flow coming into their franchise. And again, a huge net cash balance sheet like AIM. So they didn't have any issues with having to invest in production, get more machines out there, get the distribution chain going, get more consumables available. So it's a really good virtual cycle. So that quality piece, we would argue, was critical to holding up. In then coming out, the first sort of 2 or 3 months we held up pretty well. March, April, May we did well. June pretty well. Traditionally, because we have this view of always being a little cautious about companies and what can go wrong, but also the more steady recurring businesses. Traditionally, out of a cycle, you then get a point where you get this big kicker, and what happens then is you get often commodities reflating, you get oil prices often as well going up, you get more cyclical businesses rebounding, and these are all of the companies I mentioned are not in complete control of their destiny because those other factors had killed them off previously. You also get banks opening the lending books again. And so that's the point at which we start lagging. So you would have seen the last quarter of last year, we lagged. The same again, the first quarter of this year, we lagged again because you got then this shift of, well, the economy's reopening. What about travel? What about discretionary consumer goods? What about this, that? We're thinking, okay, the next 10 years, which are the quality businesses that will have that strength throughout the cycle? And so we've had that 6 months of softness relative to the index, but May, it's coming back. We're about equal. June, we did really well. July is looking really good. And it feels like, again, back into this almost start of more of a mid-cycle, our businesses are performing very well and in really good health and generating really good announcements. So when they're coming out with their earnings announcements, they're all looking pretty positive.
It's good. Now, we've spoken about lots of stocks already, which is great. Nick, I want to pick up on some of the bigger positions in the portfolio. I find the portfolio absolutely fascinating at the moment in terms of looking at the sector exposure and the country exposure. So just so everyone knows, the fund is heavily underweight the US, which we saw in a previous chart, but you're overweight IT in terms of sector exposure, which I think is incredible. So I think lots of people would ask how that's possible, but we can work through that. The biggest position in the portfolio I want to talk about just briefly, Fortinet, which is actually the 59th biggest IT stock in the world. So this is the other thing, you're overweight IT, but there's no Apple, Microsoft, Amazon, Google, Facebook, Tesla, and Tencent. Just found out this morning that Snapchat's got a market capitalization of 117 billion, which made me feel really old, Nick. But anyway, but Fortinet, it has a $60 billion market cap, which is 44 billion US. And to think of that in terms of a relative size, that's the combined market capitalization of Woolworths and Coles here in Australia. So it's a business that I can't imagine many people have heard of. But it's quite big when you can compare it to our stocks on the market. So can you talk about Fortinet for a couple of minutes?
Yeah, for sure. And it's if you want to feel old, well, it's not that old really. And thinking about the FANGs and some of the issues we've had with those, I mean, there was that MySpace or whatever was the most visited website back in 2008. So things change. Yeah, we've never owned any of the FANGs or the mega cap US tech stocks. We've been massively underweight the US for the life of the fund, which you could well argue was a mistake in some respects. But we've always had concerns with many of the companies and the valuations. Fortinet, on the other hand, is a fascinating business, and the top 10 hopefully explains how we work, which we're going out to find really great quality ideas starting from scratch. We're not starting with the index and trying to pick out who's better than who. So Fortinet's a US-listed cybersecurity company. It develops and markets both hardware and software for cybersecurity. So you're thinking about firewalls, antivirus, preventing intrusion, endpoint security, and the like. Fascinating background. On the stewardship side, it started by two Chinese brothers who grew up in Beijing, of all places. and had to choose before playing in the national team in volleyball or going to university. And naturally, their parents, who were academics, I believe, or engineers, encouraged them to go the university route. And so they went to university in engineering. And from the age of 29, one of the brothers started his first business called SIS, which was designing firewalls. This is back in 1993, I think, when he was studying at Stanford. So obviously quite visionary, quite early on, entrepreneurial. Ran the business for a few years, went really well, but worked out he needed to fix something. There was a part of it that he needed to improve. So the two brothers got together and started a second business in 1998, NetScreen. And they were watching a lot of the competition, like Checkpoint Software out of Israel, and the way that business had expanded with some PE assistance and venture capitals, and thought, let's go that route, let's try it out. So they got into bed with Sequoia, the big venture capital firm in the US in the late 90s. And quite quickly, Sequoia then got rid of the brothers and tried to professionalize and grow this business. And so obviously being entrepreneurial, they thought, right, let's have a third shot and we're going to run it our way and we're going to do what we want to do. So they created Fortinet, and they made the improvements that they saw the failings in the previous businesses. They're listed in 2009. Since 2009, so you're looking at 12 years, they've grown on average 24% per annum in terms of their sales. They're actually now the second largest cybersecurity company by revenues. They compete with the likes of Palo Alto and Cisco. And we love it. We love the way they run their business. They're innovative. They've built from scratch the technology in what they're selling. They haven't gone the acquisition route of picking up other people's technology. They learn from crises really well. So even the current crises, they're really focused on emerging stronger in the enterprise network security side of things. And so because they're attracted to that because of all the opportunities around 5G, greater amounts of data, the rollout of, I guess, more structural tailwinds around internets and network communities, and obviously this huge cyber security risk that we have, that we hear about on both the political level, but also the corporate and the personal level, where we are all at risk and there are multiple threats out there. So they've maintained loads of really innovative R&D all the way through. The brothers are engineers at heart. They're still keen to be engineers, not just run a business. They operate with zero debt. They generate great cash returns. They've got a huge amount of cash on the balance sheet. The majority of the sales of that subscription model, software for a service. So you've got this recurring low OPEX cost. So it's not a big CapEx cost for companies, for their clients. In cybersecurity, requires very little CapEx of their own. And it's just a fantastic business. They've just hired, they've just had a change to their board. They've got a woman in, Kelly DeCourty's come into the board. She heads up corporate sales at Google Cloud and was previously at HP. So really good pedigree at thinking about corporate security and enabling them to move into that area more. And so we just think it's a great business, really good long-term stewards. They've learned from mistakes over decades, growing really fast, dominant market share, innovative, really well positioned. Cybersecurity should be a really strong tailwind for the next cycle.
Yeah, intuitively makes sense. Now, can we do a couple of minutes on Hoya? I'll tell you what, Nick, my Googling wasn't very good with Hoya this morning because I was just coming up with all this stuff about plants. So could you please tell us about Hoya for a couple of minutes?
Hoya's a lens and eyeglass lens company. Really interesting history as well, from the 1940s in Japan, Japanese listed. So they're founded by two brothers who were involved in optical glass, so including glass for cameras in fighter jets in the war. Obviously, that business changed after World War II, and they moved into more crystal-style tableware, and then reinvented themselves again, moving into more technology. So in the 1950s, they moved into eyeglasses and lenses. They also used that experience to move into more precision glass. And so in the 1980s, we're able to move into the glass substrate side of semiconductors. And now what they have today is this business where they have a healthcare side, which is both eye lenses and eyeglasses, including very innovative. They've created many of the innovations around things like disposable one-use lenses, the consumables around that as well, the liquids. They're also into endoscopes, the cameras in endoscopes for surgeries. And then they've got this amazing semiconductor business where they provide the high-tech glass substrate for making high-end EUV related semiconductors. And so the things we love about them is that the CEO is third generation in the family running the business. He's still a shareholder. He's running the business for the next generation, the long term. He's been quite entrepreneurial in that journey of reinventing their business and creating the next wave of growth. They are meeting a wonderful need. It's estimated by the WHO that around 2.6 billion people on the planet need access to eye correction. So either glasses or lenses or even eye surgery and do not have it. So you've got a massive addressable market. They're growing really well, particularly in the Asia Pacific. They're obviously the leading market share in Japan, tend to be one or two in many of the other countries in Asia. They have the largest lens manufacturing facility in the world in Thailand. And then they've got this fantastic semiconductor business where they have 85% market share of mask blanks, which are consumables going into the high-end EUV lithography machines, which are making semiconductors.
Now, I'm going to cut you off there because I want to squeeze in one more. You've added Texas Instruments into the portfolio, Nick, the last quarter of last calendar year. Now, just so you know, Texas Instruments gives people of my generation nightmares because it reminds us of our mathematics exams because they used to make all the calculators. So I had to squeeze in Texas Instruments before we do a quick wrap up and market outlook.
Yeah, absolutely. I had a TI calculator as well. It gives shivers, actually, doesn't it?
It does.
So they were a calculator company. They're now a major analog semiconductor company. And, you know, semiconductors are fascinating in that we do chips, basically, we have in everything now, from obviously cars have 100-fold more chips than a car did 10 years ago. They're in our computers, they're in our devices, they're in our lights, they're in everything. And they're really changing the world in terms of 5G, artificial intelligence, you name it. Texas Instruments has been quite an innovative business in this field. So they produced the world's first commercial silicon transistor. They continue to be cutting edge in R&D. They have a very strong R&D culture in itself, and they're operating in analog integrated circuit design. So not the digital, which is more the almost the more modern, fancy, high end, but we're actually more attractive to this part of the market because it's highly fragmented. The products last a very long time. So once they're designed into customers' products, they tend to stick because the average selling cost is very, very low. You're often looking at something like 35 cents for one of these, but you require an engineer to change it out in the design process. So why bother? On top of that, it's quite unique in their process technology around innovation. So they don't have, the analog side doesn't have the same rules that the digital side have. It's more free-form painting in a way. And so the people they hire are different. You need a PhD to sit there learning their stuff for 5 years, whereas you can come out of university with an engineering degree and go into a Cadence and do some digital design, for example. Their biggest customer is about 1% of sales, so it's really safe, broad spread customer base. Their biggest SKU is 0.1%, so they've got a whole range of products they can sell. And this just makes them a really attractive part of the industry. Lastly, it's different in terms of the CapEx. So you'll see semiconductors is a really fascinating industry at the moment, not least because there's huge geopolitics going on that's shaping the world right now around the Taiwan Straits and this technology divide between China and the West. But the semiconductors that are building the big factories in places like the US primarily, like your TSMCs, they're building $20-30 billion facilities to create these chips. It's very different on the analog side. It's a lot lower cost on the CapEx side. You're looking at 3 to 5 billion. They actually reuse a lot of the materials anyway. A lot of the equipment's secondhand. And so it's a different equation on the return on capital then. They're a high return business. Lastly, got a great corporate attitude and memory. The last time we spoke to them, they brought up the 1987 crash and the problems the company had then with cash and concerns about not being able to pay staff salaries and not being able to pay they had to sell their businesses and lease them back. And that is indelibly printed on the corporate memory of the company. And, you know, they run the business a lot more conservatively. And all that, we've got a business that produces about a 33% return on invested capital and earnings growth per share per annum around about that mid-teen, around 14%. So it should reward shareholders from this level very handsomely.
Interesting business. Now, we're going to stick to the hour, Nick. I'm going to get you to encapsulate all the issues in the world in an outlook that's no more than 2 minutes, which I know is very, very difficult, but please do your best.
Okay. So one of the big ones at the moment is inflation. Where is it going? For how long? We certainly don't know. What we do know is that central banks and governments continue to prop up liquidity and asset prices at the moment. If inflation comes through and they decide not to do that, the timing will become an issue because it'll be incredibly difficult for them to get the timing right. It's instructive to look at countries like China. They were the first ones into COVID, the first ones out, the first ones to get through to the next phase. Their economy is slowing down quite rapidly. It's quite possible that growth around the world slows down over the next year or two. And the lever will be more monetary policy, more support. At the same time, arguably, there's early signs of changes to the way that neoliberal economics is running in some respects. So you've got places like the US starting to more actively move on things like inequality, more actively potentially redress the balance between capital taking returns over labour. You've got a population there where the average person is worse off than 10, 20 and 30 years ago. And so they're starting to show signs of recognising that. Talks of reversing healthcare policies, reversing taxes. And then at some point as a globe, we'll need to start paying for COVID. We need to fund all of this money somewhere, somehow. At the moment, it's our children who will be left the bill, but you're seeing signs here again with tax talks in the UK recently around pensions. So there's a huge amount of uncertainty. Any of those things can create uncertainty, which will unnerve the markets. And then on top of that, there's geopolitics. China and the West at the moment is just fascinating. Taiwan Straits in particular, the race in technology is incredible. And there's two divided parts of the world emerging. So all of that suggests to us uncertainty, invest in quality, invest in companies that can try and control their own destiny, run by people who are looking at the longer part of the cycle, not just next month, and meeting bonuses, and are operating conservatively and understand that as a world, we have increasing environmental challenges and social needs, and those things provide fantastic opportunity.
Interesting. Thanks for that, Nick. Really appreciate it. Thanks for your time today. We always appreciate you presenting to our clients. To all our clients and guests, thank you for joining us today. Stay safe and well, and we look forward to seeing you all face to face, hopefully in the not too distant future. Take care.
Thanks, Patrick.
Thanks, Nick.